Okay, guys, so welcome to our third episode here. We have a special guest today, so we're hoping that you get tremendous value. The episode title today is Investing in Apartment Syndications, Unveiling the Secrets of a Pro Operator. So again, welcome to the third episode of Invested Passively in US Multifamily Show. So again, we have a special guest with us today. We're beyond excited and hope you get tremendous value from the special guest we have today. For those new tuning in, I'm your host, Jefferson Ortiz, and my co-host, Jonathan Ortiz. What we do is we partner up with passive investors to acquire large multifamilies, and we usually get double-digit returns. And our main focus is usually in the Sunbelt region, which includes North Carolina, South Carolina, Atlanta, Tennessee. In today's episode, we will be, again, covering the unveiling secrets of a pro operator. And just to kind of give you guys a little background on our special guest today. So her name is Elsa. She is the co-founder and COO of Invest Now Capital, a real estate private equity firm. Elsa is passionate about real estate and currently manages over 30 million of commercial real estate, specifically in multifamily and pre-construction development. She is also a national speaker and a multifamily coach. Prior to managing Invest Now Capital, Elsa served as a founder, CEO of Sunrise Development and CFO of North Star Development, a full-service pre-construction development firm. Elsa also has 15 plus years corporate years as a financial controller prior to her real estate career. So without further ado, thank you, Elsa, for being here, and what an impressive resume you have there.
Thank you so much, Jefferson and John, for this opportunity. I really appreciate it.
Thank you, Elsa. And yeah, so what we can do is we can get started. You can tell us a little bit about your background, just kind of how you stumble across multifamily, and just kind of tell us a little bit about yourself.
So as you just mentioned on my bio, I came from an accounting background. So I worked in accounting ever since I graduated from college in 1999. So that's tell you how old I am now. I worked in that field for about 15 years. But then I decided that it wasn't fulfilling. So I'm like, okay, you know what? I really like real estate. I have a real estate license. I might as well just give it a shot. So then I quit my accounting job. I was a controller at the time. And then I went into doing real estate full-time as a real estate agent. So I did both residential and commercial properties, focused probably more on residential than commercial. And I was introduced to syndication in 2019 by a broker in the same office where I work when I was doing real estate. They were doing a syndication for a hotel development at the time. So that's when I first learned about syndication. And long story short, I joined that deal as an LP. And then later I did my first GP deal as also in land syndication. And in 2020, when we had COVID, hotel wasn't doing really well. So I shifted gear, joined a mastermind group, and learn about doing apartment syndication, learning about multifamily. And that's kind of where I am today. Been doing this in mid-2020 until now.
Wow, that's really impressive. And I just kind of wrote some notes here. So I know you mentioned you were introduced in 2019. Now, prior to that, you were a realtor, like a broker? Okay.
I was a real estate agent.
Okay. Did you ever do any commercial while you were doing that, or mainly was residential?
I did. So okay. I was doing both commercial and residential. So that's why when I went full-time into doing investment, it wasn't too difficult for me. Mm-hmm. It's because I already have the background in accounting, so I know how to analyze the numbers. I know how to analyze deals. And given my experience in dealing with brokers and due diligence, because I had to do all that for my clients, it was quite an easy transition for me. The only thing that I had to learn was the compliance, because right now we work with investors, right? So I need to learn about the compliance, the SEC rules and regulation, and I need to learn how to share. Usually if we buy a deal for ourselves, we don't need to look too much at the profit margin. But now when I analyze the deal, the profit margin needs to be bigger because we need to share a portion of that with our investors. A big portion of that we share with our investors. So then the works are pretty much the same, but I think it's a lot more intensive in the field that we're doing right now.
Okay, okay. No, I appreciate that. I don't know if I might have missed it, but you said your first multifamily property was that it was an LP, and then the second deal that you did as a general partner. So I guess that was a GP LP. So it wasn't like you didn't buy the multifamily yourself. You brought some partners in for the first multifamily.
So the first LP I did was actually not a multifamily, Jefferson. It was actually a hospitality deal. It was a land development deal.
Okay.
And
Awesome.
then, yeah, so then and then the second one that I did, I was actually the GP. So it was a different deal that I partnered with one of the GP from the previous company.
Okay.
And we went out and we did our first syndication, and that was also a land development deal here in California.
Okay.
And the
How
third one
is
was apartment.
how was your experience as an LP learning about the syndication when you first started on that first deal in the hospitality? How was that deal, and how was your experience?
That's a really good question, John. I didn't know anything. I didn't even know that I invested in a syndication. Honestly, you're gonna laugh at me. I did not know that I was doing a syndication like we all know. Even after my second deal, when I was a GP, I had no idea it's called syndication. I didn't know anything about 506C, 506B. All I did was that we identify a piece of property that we wanted to purchase, but we didn't have enough money to buy it ourselves. So it was like, and my partner at the time, she go, well, we can go and we bring investor in with us and we're gonna share. We structure it as a very high preferred return. It was 25% preferred return. And then we had an attorney. I mean, we did everything correctly. We had an SEC attorney, but I didn't know about that terminology. All I know was he's like, okay, have them read this, have them sign this. And then that's all we did. I just went out. I went to a lot of meetup group with her. We met people. We told them, passionately about our deal and how we could make money from it. We told them we buy this for $7 million. We're gonna sell it for 12. And they go, really? I'm like, yeah, we can sell it for 12. If you come, you invest with us, we're gonna give you 25% return, so on and so forth, right? And that's all I did. And they go, okay, so what do I do? And then go, okay, read this and sign this. And they did everything manually. I didn't know there are online software they could sign electronically. So the subscription agreement, they signed everything manually. It was just so funny. And fast forward when I joined a mastermind group and learned about multifamily, and I read through all that and I learned that. I'm like, wait a minute, I did this before.
Wow.
I'm like, no, I have seen this, this PPM. We use this before. We have the operating agreement. Like, I did this before. It should be easy. So, but now that you know what it is, I took it a lot more seriously. I read every single page because remember, I came from an accounting background. So when I partnered with that lady on my very first GP deal, my role was on the number part, right? I underwrote the number, and her role was all the administrative paperwork, SEC, and she didn't tell me about the importance of that. All I told her was that I'm going to do the number, you're going to do the paperwork. So we kind of just divide and conquer, right? And so I didn't even bother to explore more about that option. But until you step into that role yourself, and that's when I learned, and I took it way more seriously than before. Not that it wasn't serious before, but I relied on her to do all of that part.
No. What's really interesting?
Short, that's kind of how I got into this.
Nice. No, that's awesome. That's a great story, and it's interesting because a couple points that I kind of want to touch from what you mentioned. The first one is that you got it started by investing as an LP. And then you got into the GP, which I think there's a lot of folks that start that way. Sometimes they start as an LP, and then they get experience, they build a relationship with the GP team, and then they get into another deal as a GP. You build those relationships, which I think is really interesting, and it's a good way to get started in multifamily and syndications.
Right.
And then the other thing that I think is interesting is that obviously in the syndication, it is a team sport, so we always learn that there's different roles. Now, from the sounds of it, it sounds like you're like this hybrid where you can do multiple things because you can look at the numbers, but you have the experience as a realtor, the broker, to find deals, build those relationships, and then now obviously you're raising capital. So it sounds like you can pretty much do all of the different roles in the GP team. Would you say you have a partner that helps you with the asset management? Is that kind of what we would bring a partner in? Because it sounds like you have all the different things that you need to put a deal together.
Like you say, we can only do so much, right? Yes, I can underwrite deal. I can raise some capitals. I can do some assets management, but there's only one me. So in order for us to grow, we need to keep an open mind, right? So the more people that we, of course you can just go out and partner with everybody, but I have numbers of partners that help me to underwrite deals, because I cannot just sit at home and underwrite deals all day. So I have a couple people that I ask them to help me underwrite the deals as well, and then I partner with a lot of individuals who also helps on the investor relations side, right? We were to do bigger deals, want to buy more, we definitely want to have that option open so we can partner. And assets management is really one of the key role in the in the syndication model as well, because you can only do so much. Again, as I have a rock star assets management manager for my property in Pittsburgh, right? And then between me and my partner Garrison Gilbert, he also helps on a lot of assets that we have. But usually what we try to do is we try to identify one strong person in every partnership, and we kind of just pass on the baton to him or her and say, can you take charge on this one, and work closely with the property managers. We'll always be there, right? But we want to watch it very loosely, because we want them to also take on that asset management role to learn and grow themselves. So that's kind of how we kind of just, built our company around that concept, is that we are open to partner with, people, whether as a limited partner or general partners. I think there's always room for that.
Interesting. No, I love that. I love the points that you touch on. Like you can only do so much, and that's why we love syndication, because it is a team sport. You have so many different things going on at the same time. So it's really important to build a good team around you and be able to partner up with folks on different deals, right? You can grow a lot faster, right? Now, Elsa, I'm curious to learn a little bit more about what your company or yourself, what your investment criteria was when you maybe first got interested, and then what it is now. Has it changed over time? And just tell us a little bit about what your investment criteria looks like for assets that you guys are acquiring.
So we don't really focus on a particular market or a particular deal size. Even though I do have certain criteria when it comes to market research. So I don't want to invest in a market where I know that the population is decreasing, or the median home value is also going down, or has been flat in the last 10 years. I don't want to invest in a very small town. I mean, it's okay if it's a small town, but it is next to a very big town, right? We have a property in Slippery Rock. It's very small, but it's right next to Pittsburgh, 45 minutes from Pittsburgh Airport, which is not bad at all. And it turned out to be one of our best assets, right? Oh, wow. So as far as my investment criteria, I read the news a lot just to see what's going on, which market is growing, and I kind of just followed that lead. It's very important for our company is to also not just to follow the market, but we also want to make sure that we have people, we call it boots on the ground. So if I were to go into the Ohio market, I want to make sure that I know somebody there, who's also doing syndication, who's also doing multifamily, so I can rely on that individual for the assets that I purchase over there to be the boots on the ground. So that's very important for us as well. I know there are many markets out there. Like recently, somebody brought me a deal in New Orleans, and it's a super strong deal. But unfortunately, I had to turn it down because I don't know anybody over there. Right? As much as I want to do it, we have to take a big risk when we go in there, blindly without knowing, without having a strong asset management person on the ground or a property manager that I already have relationship with. So, and that's like, especially when we do value add property, that's one of the very important aspects is a strong property management company working along outside. So that's kind of my investment criteria is when I want to make sure that I have all that covered before we even consider going into that market.
Interesting.
Very
I
good.
appreciate you sharing that. Yeah, because a lot of people, and I think a lot of people in the industry, they really worry about closing on deals. But like you said, it's so important to have that asset management, that team on the ground that can help you accomplish your investment, your business plan, right? Without that, you're just kind of closing on deals, but not stabilizing them, not adding the value, like you said, and that's the whole part of value add multifamily. Now, you're in your space. I know you in the bio you mentioned you're in the pre-construction spaces a little bit more as well. Do you see yourself continuing down the path of like value add multifamily, or like are you interested in the development space at some point, or what do you see going in regards to the development? So that's always something that we've thought about as well, right?
Yeah.
Like, development, I think, is in everybody's radar, but it's a different vehicle, if you want to call it.
Yeah, absolutely. I believe in land. I think, investing in land, there's a tremendous values there. And what we've been doing, when I say pre-construction, so what we did was that we bought raw land, and then we would go to the entitlement process to work with the city to get the site plan approval to build something, but we don't do the construction. So as soon as we got the approval, we would turn around and sell it to a builder. So that's why we call it pre-construction. Even that entitlement process, it takes more or less a year to do. It's a lot of work that we put into it, but it's also create tremendous values, because now you increase the values of the land by just having the approval for someone to go in there and build it. I still have a couple land deal that I'm working on right now. And funny that you asked the question, because somebody just sent me an opportunity here in California. He just sent it to me yesterday. And he called me just right now when we spoke. That is a piece of, it's a 12 units apartment in Los Angeles. It's not in Los Angeles County, so which is good because it doesn't have strict rent control. But it's in the LA area, and it sits on a piece of land that's 30 acres. Very, very big piece of land.
Wow.
So it's huge, right? And it has those little apartments on it. So he wanted to partner with me because he knows that I also have some development background. So he wanted to partner with me and purchase that. And then we do the entitlement for the land to build like 100 plus affordable housing there. So it's a great plan. I don't know if we do it or not. Like you say, when we do land development, it takes a long time. And for a little 12 units apartment that's extremely under market rent right now, we're not going to be able to collect any money, to pay the preferred return to our investors. So if whoever going to invest with us, they're probably going to need to sit and wait for 1 to 2 years before they're going to see any paycheck that come to them. So, but the trade-off is that, you buy this thing for a very small price, but the potential is so high when we exit, right? So the higher risk that we take, the higher the return is going to be.
Are those deals also structured as a multifamily syndication as far as your JP and LP structure when you're doing pre-construction?
Yeah, we do. So the two deals that I've done in the past, I've structured a very strong return for the investors. We did a 35% return, not annualized return, okay, just a one time. So like, let's say they invest $100,000. When we exit the deal, they'll make $35,000, right? Okay. Whether it's 1 year or 2 years, it's still $35,000. But we structure a very high return. I know there are sponsors, which I think if I were to do this LA deal, I may just structure it this way. We will do a equity share with the investors. So instead of a strong 35-40% return, we're going to structure maybe an 80-20 split. So if we were to sell this piece of land after we get it entitled for, let's say, $10 million, right? we'll do a 80-20 split with them. When they get 80% and we get 20%.
Awesome. And I just wanted to touch base on something that you kind of mentioned. It kind of leads to kind of what we're talking about here. Now, you and the team, you guys are not afraid to invest in, what most people call blue states, or, states where the tenants have a lot of control, and that's very similar to here in Canada. For somebody who may be shy or maybe scared to invest in like a blue state like California because of the tenants and the landlord rules, what are some ways that you guys have been able to mitigate those risks, or what do you see? I know you kind of touched on it earlier with the land. Like, there's obviously pros and cons. What would you say are some of the pros and some of the cons of investing in a place like California or one of these blue states, as opposed to like a red state like most people would invest in? I'm curious to hear that.
Yeah, so I mean, the reason California or New York or Canada, where you stay, have very strict rent control or more tenant friendly is because the rental demand is so high, right? So if the state don't step in and put some control over that, it eventually gonna drive out all the people, all the blue collar or people that don't make enough money because the demand is so high. And that's the reason why they have rent control, is to be able to make it affordable for everyone. With that being said, the reason I'm still buying in California because of that, because I know I can rent out the apartments because of the demand, right? I don't have to worry about high vacancy. I don't have to
very good point.
worry about oh no, it's going to be the lack of jobs. Nobody going to rent my apartment. So that's the trade-off right there. So that's the risk that we have to take. But at the same time, that's the pros, is that we know that I can rent this out. If I can, as long as I have a vacant apartment, I don't worry too much about vacancy. If you look at a pro forma here for deals that sell in California, you're going to see the max that most brokers usually 3%. Whereas in some state, they would do 5 to 8%, even 10%. So the vacancy factor here is very low. So that's one of the things. And I try to mitigate that risk by buying smaller apartments, because I just don't know what's going to happen. And also, it's expensive here. We're talking about $250 to maybe $300 per square foot, right? Whereas in other places it's only, $100. So I'm buying a one-bedroom apartment in California. This is where I stay, or in the Los Angeles area. Maybe I pay between $250 to $350 for a one-bedroom, whereas I can get, 3 of that in Florida. So that's why the price point is a lot higher over here. And buying a smaller apartment, I just mitigate that risk a lot. And the renovation is also faster. So that's how I usually structure that. And I mitigate the risk for my investors for this type of deals. I usually don't bring them in as equity partner. I bring them in as I pay them more on a preferred return structure because. And I do quarterly distribution. So even if I cannot, turn the property around the way that I projected it, and let's say I buy it for $2 million and I sell it for $2 million, let's say I done nothing to it, and then I make no money when I sell it for $2 million. So if I structure it as an equity return for them, they'll get nothing, right? They get nothing if it's an equity because there's no profit. But if I structure it as a 10% preferred return every year and I do quarterly distribution, then every quarter they'll get some money from me. Yes. Right? They'll still make that preferred return even though I might not be able to turn that. So the risk that I'm taking is the risk on myself because I put my money out to pay that preferred return. I invest my own money into the deal to pay that. So I think the investor have a peace of mind. And if I cannot turn the property around, I sell it, then I'll still take that money and return it to them, right? So that capital is still there. So that's kind of how but then I cannot afford to do a lot of doors just because it's very expensive to do that.
Very interesting. And again, so from what you've said, you've said it many times, in your brain, you're always thinking about the investor before anything else. Like your priority is the investors, which is really good to hear from an operator. The name of the episode today, is mainly a pro operator like yourself. So that's kind of why we're touching base on that. That you're always talking about your investors and the investors. That's your priority, because obviously they're investing their hard-earned money.
Right.
So that's really interesting. Okay. Now, Elsa, for a lot of our followers that may be on the fence about, maybe they don't know how to invest in real estate, maybe they want to do something more passively. I know we touched about this once or twice, but you started as an LP. Why do you think that's a good way to get into a deal as an LP? Whether you just want to invest as an LP or whether you want to go LP to GP, why do you think that's a good strategy for folks to get started in real estate, or multifamily rather?
When I invested as an LP on my very first deal, I was so new to syndication. Like I said, I didn't even know what syndication was. But when they showed me the plan of what they were going to do with the site, it was development. And I know that I've always wanted to do development, right? As soon as they got into real estate, it's like, I want to do development. So I'm like, oh my God, this is the opportunity. And so I invest in it with the hope that I would be able to shadow them and learn whatever I could. So that's why I decided to invest with that particular, sponsor at the time. It's, even though as a limited partner, you cannot make any decision for the company, but you could still benefit sitting on the sideline and watch what they do through their, if a sponsor is doing the right thing, they'll have monthly communication with you. They will have quarterly calls. So they'll update you. They'll tell you what they've been working on. So you could still learn a ton just from those, watching what they do, right? And then from there, you can glean from that experience and perhaps go out and start, buying. And it's a full-time job by itself, but if you have the time to do it, then it's always good just to spend some money to learn. And it's, you're not really spending the money because you're making money when you invest, right? You just don't have to do the active work. But it's definitely worth it to spend a year or two to shadow somebody who have the experience and watch them from the sideline before you can dive in there. And I promise, I have done so many, I've been through a lot of jobs. I've been doing quite a few deals, and I have not seen one deal that went exactly the way that we had projected it. There's always something come up, right? Doesn't mean it's a failed deal, no, but we learn from the experience. So no two projects is the same, and we learn what we can, and we also mitigate a lot of risk by learning from other people's experience.
Wow, that's some really good piece of advice, and that's why even whenever we have any deals, we encourage any LP partners that may be investing into the deals to come to the walkthrough with us, so they can get a sense of the building, the asset, the location. They can really get a sense of it. Especially some of them want to be more hands-on, where you can, like you said, you can give them that experience by maybe give them access to one of the recorded asset management calls, or just getting them more exposed to the business, and then that allows them to also grow and want to invest in other future projects. Some of them might invest as an LP. They're like, I enjoy investing in a project this way as opposed to being more active. Like you said, depends on your time. So that's really interesting that you mentioned that. Okay, now Elsa, something I wanted to touch on, because we kind of we might have skipped it, but when you got started in real estate in general, did you ever buy single family houses, or you just skipped that, went into the LP and then a GP? Did you skip the single family space, or did you also kind of buy some single families early on?
I skip it.
That's what I thought. Okay, I had it written down here. Oh, that's awesome.
I know they taught me how to do single family fix and flip, right? So no, I think you don't have to strike at the single family at all. It's good to do single family so you can also learn the experience, right? The rehab experience and all that. But a lot of time when we start, I notice with a lot of people, when they start with single family, it is so difficult for them to get into multifamily. Because when you learn to snowboard and now you learn to ski, it's a different skill set. It's the same skill set. You still go down the slope, but then you need to brake differently. You need to slide differently, and that's the same. I see the single family folks as much as they want to break into multifamily, it's a challenge for them, I guess, because their mindset needs to be shifted a little bit. They need to underwrite it a little bit differently than the way we underwrite single family. And a lot of single family folks, they do it by themselves, 100% control over everything. And as we mentioned many times, syndication multifamily is a team sport. I'm not like, I am one of the member of the team. So I have other members that I need to collaborate with, and I need to learn how to sit back and let other people make decisions when it needed to.
Wow, that's the golden piece of advice there. And coming from somebody like yourself, very successful, because a lot of people, and it's good that you touch on that, because a lot of people, maybe even some of our listeners, they maybe have a single family house and they're trying to get into the multifamily space. Maybe they want to learn it, but then they come to realize that it's a lot. Like you said, it is a full-time job, and sometimes it's much better to just invest as an LP and just get that experience and then see if that is something that you want to proceed as a full-time job. So that's really interesting that you were able to skip or not have to go through those hurdles of buying the smaller multifamilies or the single family houses. And like you mentioned, they are valued so different, right? One is based on comparables, the other one is based on the income, which is probably, I say, one of the single hand most different differences between the two. No, that's great. And one other question that we had for you here also that we had written down, when it comes to working with the right partnership, sponsor, let's say, why is that so important when you're investing as the LP? Why is it so important to work with, maybe a team that has a track record, or work with the right? Why is your sponsor / GP team such a important part of your decision when choosing a sponsor?
I don't want to disqualify new sponsor either. They are new. That doesn't mean that they don't know what they're doing. Right. So a lot of it to me is you want to work with sponsor who have the integrity. We were very lucky during COVID time because real estate went up tremendously. Right. Interest rate was so low, so everything just skyrocketed. So whoever that bought properties, I guess before 2020, without even doing anything, they could easily turn it around and sell it for a profit between 2020 to 2022. But you want to work with someone who really transparent, who have integrity, good people, integrity, transparent. I would say, I wouldn't say underwriting skill is important, but you have to be realistic about your projection, right? Our target and our projection and what you get. And they have to be able to be there's always risk when it comes to investment. Doesn't matter if you buy houses or stocks or apartment buildings. However, are they conservative enough in their projection in order to mitigate the risk for the investors? So if I were to go back and question the very first sponsor that I worked with, I probably wouldn't do it, right? Just because I wanted to do it because I wanted to learn. But now with where I am right now, looking back, I'm like, my God, I just dive right in without even I did not do any investigation about the sponsor. I didn't ask about the process. I didn't do any research at all on my own, right? So I highly recommend any LP, any investors that's sitting on the sideline thinking about want to invest, make sure you spend some time to learn, to know about the sponsor and how they look at the numbers. I came from a number background. I think it's very important to look at all the projected rent, the stabilization period. It needs to be realistic, right? You cannot turn 40 apartments in 1 month. It's just unreal. Like if you have a 200 units apartment that you need to stabilize, that's not going to take a year. That's going to take 3-4 years. So you want to make sure that you know your number and you read the projection to make sure that they're not too aggressive with that. So those are the things that I highly recommend the investor to explore and learn about the integrity. Maybe if you can do a little bit of research on that sponsors and see what kind of reputation they have. It's very important.
Wow, golden nuggets dropped by Elsa. No, I completely agree with you on all the points that you touched there, and I like what you said about realistic projections, especially now in this environment where people were projecting rents to go X amount and now they're not, they're not going up as planned, right? That's when it's important to have a strong team with a good analytical skills.
As an experienced syndicator for the last couple years, and GP, what would you say has been one of your biggest learning curves that you've had?
One of the biggest learning curves that I have is that I feel like I have not been conservative enough with my underwriting. Even though, all the properties that we have going on right now, I don't have any property, thank God, knock on wood. We don't have anything that I would lose sleep at night. But looking back on the loans, like knowing that the interest rate was so low back then, instead of getting a 5 years interest only loan, I should probably lock it up for 30 years, right? If the rate may be just 0.15, or maybe just a little bit higher, maybe 10 or 15 basis point higher, but that would definitely, if we could lock it in for a longer period of time, that would be much better for our deal on investors. That's for one. We touched briefly on the asset management role and how important they play in the value add component. Because when you buy value add apartments, the asset manager is so critical. They're the one who out there watching the contractors, working alongside with the PM to stabilize the assets. So a good asset manager will do a lot of work. They do a research on, what's the cheapest landscaper I can get out there and cut the grass, right? Instead of paying $500, I can find someone that pay $200. And little things like that, it adds up. So a good asset manager working alongside with property management is really critical. I know a little bit sidetracked from the question, but
no, you're nailing it right on.
Those were my learning curves. I cannot, in the beginning, I was a little bit loose on that end. And it took a lot longer for us to stabilize the assets. One of the property we work on, it cost us 6 months longer to renovate the property, right? 6 months doesn't sound like a lot. A lot of time, the construction or the rehab takes 3 months longer. But 3 to 6 months seem normal. But if you were to take that and you factor it back into the loan that we have to pay, right, we factor back into the preferred return that we have to pay, the rent that we lost for that 6 months, it's a lot of money, right? So it really adds up. So keep a close eyes on the PM, keep a very close eyes on the contractors if you were to do value add apartments, and don't just take their word for it. You need to have someone on the ground, boots on the floor, check on them a couple times a week to make sure that they're doing what they're supposed to be doing, because that saves us a lot of time and a lot of money.
That's really good. That's really good points and really good golden nuggets that you're dropping here. So I took some notes myself because it is something to consider, and something that you learn as you go. Now, kind of as we're talking about this subject here, what are you doing differently now in terms of your underwriting with the market and the interest rates that we're in, as opposed to before? Like, is there anything you guys have pivot or changed in your underwriting, or when you're running numbers or due diligence or anything in general that you guys are doing differently as opposed to before the interest rates started going up?
Yeah, definitely. Because the interest rate is so high, so that's also drive up the cap rate, right? So the cap rate, we need to do a little bit of research on and this is what I learned recently as well. We are projecting the exit cap rate always a little bit higher than the purchase cap rate, and we add about 10 basis points to every year that we, if we were to use the same Michael Blank thing, I believe they add 10 basis points to every year for the exit cap rate. However, because the interest rate had progressively increased for so fast the last year, 10 basis points is not enough, in my opinion, for the exit cap. So we definitely need to be more aggressive with the exit cap rate, especially now that you stabilize the assets. There's not a lot of room for the next buyer to purchase the property. There's nothing for them to do to add value. So you might want to use even a higher cap rate. Instead of a 6%, it could have been a 6.5%, right? Just to be on the safe side, because remember, if there's no meat on the bones for the next buyer, they're not going to be willing to pay you a lower cap rate, because there's really nothing for them to do now. It's just a cash flow and assets for them. But with the interest rate being so high, they might not be even cash flowing if they were to pay the price that we wanted them to pay. So that would reflect strongly on my underwriting now, because I use a much higher exit cap rate when I underwrite, and it's all relative to the market, right? But you never want to underwrite a deal that exit cap rate is the same as the purchase cap rate. That is just way too aggressive. Okay, so keep that in mind.
Appreciate
Awesome.
it. No, that's
Awesome. I wanted to ask, what is your why, and why is this so important to your investment, and what's kind of your mindset throughout the last couple of years, and what keeps you focused, and what do you believe in if you do any sort of activities or anything like that?
Well, I needed to, because I once I start on this new journey, I pretty much almost walk away from my real estate job. So I don't have anything else to do but this. So, with all the hours that I get, the only thing that I need to work on is basically finding deals and talking to people and fine-tuning my knowledge and just do more deals. So because I get bills to pay, I have children that I need to raise.
Of course, your children is a big part of it.
My wife is that is the job.
There you go.
But I do always have the fantasy of helping a lot of people, especially women and children in slavery. And I always, have the dream of helping them out of slavery some way, somehow. And whether I come in and partner with organization who's out there doing the work as a capital partner or hands-on helping them, I have no idea. But there are a lot of people out there that needs help, and I came from a very humble background myself, so that's something that always resonates with me, is the ability to sow back into the community and help these people in any ways that we can. And that's why we have Invest Now Capital have a nonprofit arm, and we do fund that nonprofit ourselves, and that nonprofit arm we partner with some organization in other countries to just help with the poor people in those countries.
Wow, that's really meaningful. That's very meaningful, and we can definitely relate. We're also come from humble beginnings. We're originally from Colombia, so we definitely get where you're coming from, and that's very meaningful that you want to help other people. We want to do something similar to people back home, be able to help out. No, that's awesome. And then lastly, Elsa, just as we're kind of wrapping it up here, tell us a little bit about what are some of the projects that you're currently working on, or that you're just tell us a little bit about what's in the pipeline for you, and tell us about some of the projects you're closing on and working on.
Thank you for that question, Jefferson. So I had a project that I'm looking at in California right now. Is a compound of 7 single-family houses, and we were really excited about that. But after we did our walkthrough last week, we are a little bit taken back because the damage that the previous tenant did to the properties was so much more than what we thought it would be. We haven't decided yet if we're going to walk away from the deal or not, but we are actually in negotiation with the seller right now for a price reduction, because it's going to cost us at least $200,000-$300,000 more than what we had initially thought it would be. And that's the important of doing due diligence and get all the inspector out there to do the work, is that without that you could easily blindly buy a property, and once you close you're gonna be like in a deep hole. So that's the only thing that I'm working on right now, even though I'm looking at a few properties in Cincinnati right now, and working with my underwriting team on to see if we can find one that would pencil out for us. It's a really strong market right now, the Midwest. I mean, that recently, a recent study showed that is Cincinnati one of the strongest growth right now, 33% last year.
Wow.
And the rent increase has also been tremendous. So we want to focus on Cincinnati, that market particularly right now, and I'm hoping that I would be able to find a strong deal for our investors.
Wow, that's really exciting. And yeah, Cincinnati, the Midwest has been blowing up. I know some other folks have mentioned Arkansas and in South Dakota. So it's these markets that you wouldn't really expect to be having this explosion all of a sudden are blowing up. Ohio, Cincinnati. I didn't know much about Cincinnati, but that's really good to know. Definitely we'll do some research on that. Okay, well, that's exciting. And yeah, it sucks that you had to walk away from that, or you may have to walk away from that deal, but it's better to walk away than to get yourself into something that would cost you guys $200,000-$300,000 more. That's a significant differences. Awesome, Elsa. Well, we definitely appreciate your time. For our listeners, where can they best connect with you? We will attach all your social media links like in the episode, but what is the best way to reach out to you?
They can go to my website and check our website. We do have an email link on there, and the website is investnowcapital.com. And I'm on Facebook, I'm on LinkedIn. That's probably the easiest way to track me down.
Awesome, Elsa. Well, thank you so much for giving so much value to our listeners. It was definitely a tremendous honor to have you on our podcast, and we definitely look forward to staying connected.
Thank you, Jefferson. Thank you, Jon.
Thank you so much, Elsa.
As well.
Thank you so much. God bless you. Appreciate it a lot.
Thank you.
Thank you to Elsa for their valuable insights and contributions. Please stay tuned for more episodes. Make sure to join our newsletter for live webinars, meetups, and other podcast episodes coming up, as well as follow us on social media for daily tips, as well as we'll attach the links somewhere here on this podcast. Our website is ortizequitygroup.com, and you can find us on social media, Jon.Ortiz and Jefferson.Ortiz, either on Instagram or on Facebook. We will see you guys off on the next episode, where we'll provide some market news, and we'll have another very experienced, memorable guest here on our episode. Off to the next one.